Our lessons for today is about rest of financial intermediaries in socio-economic development, economic basis for financial intermediary, concept of rest and measurement of rest. First, we discuss about a financial intermediary. So what is financial intermediary? It is a firm or an institution that acts intermediary between a provider of service and the consumer and exists for profit in the financial system, and sometimes there is a need to regulate the activities of the same. A financial intermediaries work in the savings, investment cycle of an economy by serving as consults to finance between a borrowers and the lenders. In the financial system, intermediaries like banks and insurance companies have a huge role to play given that it has been estimated that a major proportion of every dollar financed externally has been done by the banks. What is the impact of a financial intermediaries in economy? So there has an impact to our economy. So what it is? So if financial intermediaries decrease transaction cost of capital accumulation and encourage savings. Financial intermediaries have a central role to play in a market economy, where efficient allocation of resources is the responsibility of the market mechanism. In these days of increased complexity of the financial system, banks and other financial intermediaries have to come up with an innovative product and services to cater to the diverse need of the borrowers and lenders. It is the right mix of financial products along with the need for a reducing systemic risk that determines the efficacy of a financial intermediary. The importance of financial intermediaries in socio-economic development. So, if financial intermediaries may help improving the saving rate to influence the economic development by improving the quality of a financial services and reducing the transaction cost to narrow the spread between borrowing and lending rates. So what is the reasons for the existence of a financial intermediaries? So financial intermediaries exist because they improve on an intermediate of market in which the ultimate parties such as borrowers and savers or firms and investors deal directly with each other without the use of any intermediary.
The economic basis for financial intermediary. The question arises, how can financial institutions provide better financial convenience of lenders and borrowers? What is the economic basis for their success of financial alchemy, whereby they purchase and hold primary securities which are much riskier and far less liquid than the secondary securities. They sell as their liabilities to the general public and earn handsome profits on their activities. The economic basis for financial intermediation lies in the economics of skill in portfolio management and in the law of large numbers. Law of large numbers. Banks, insurance companies, unit trusts, and all other financial institutions operate under the assumption that not all creditors will make cash claims at the same time, supported by the statistical law of large numbers. In addition to that, if some creditors are withdrawing cash, some others creditor, whether old or new, are paying in cash. In addition, financial institutions regularly receive interest on loans and investment as well as repayment of loans when they come due. Reinforced with this knowledge, banks retain only a fraction of their demand liabilities and invest or lend the rest. Economic of skill in portfolio management. The average size of the portfolio of bank, assurance, and other financial institutions and the organized sectors are quite large. As a result, these financial institutions can gain multiple economies of skill in portfolio management, which can significantly increase the return on their asset holdings. These economies accrue in the following main force: reduction of risk through portfolio diversification. Borrowing investing is always risky. It carries the risk of default of valuable asset and loss of capital. A common way to reduce risk is to concentrate independent risk by placing funds in diversified portfolio. As a result, investors may lose more in several directions than make up in others. But in order to fully diversify, the portfolio size must be quite large. Otherwise, the cost of portfolio management will become prohibitive. These economies accrue in the following main force: professional management. With the size of the portfolio of assets to manage, financial institutions can hire professional managers who are well versed in the intricacies of modern finance, evaluating loan proposals, evaluating investment opportunities, monitoring loans and investment, analyzing risk, consequences, markets, and other development to promote the health of their business. These economies accrue in the following main force: indivisibilities and market imperfections. The scale of individual loans and investment is very large. Ordinary family wealth owners cannot handle them. In some cases, even financial institutions must band together, pool resources, and spread the risk of finance them. The administration cost per rupee for large loans undertaken by financial institutions is quite low. These economies accrue in the following main force: other cost economies. Due to the large business volume, the fixed cost, information cost, and various transaction costs per unit transaction of financial institutions are lower than that of ordinary family wealth owners.
Concept of risk. The chances that the outcome of an event is unfavorable and undesirable. Risk implies future uncertainty about deviation from expected earnings or expected outcome. Also, it measures the uncertainty that an investor is willing to realize a gain from investment. Measuring of risk. Risk is measured by the amount of volatility, that is, the difference between actual returns and average or expected returns. This difference is referred to as the standard deviation. Risk. So, what is a risk? Risk Investment risk is the idea that an investment will not perform as expected, that is, actual return will deviate from the expected return. Risk is measured by the amount of volatility, that is, the difference between actual returns and average expected returns. This difference is referred to as the standard deviation. Returns with a large standard deviation, showing the greatest variance from the average, have a higher volatility and are the riskier investment. For example, S&P 500 average annual return based on the data from the Standard and Poor's INC assessed November 24, 2009. S&P average annual return from 1990 to 2008, the rates have gone up and down, staying between 0 and 40% during the years 1990 through 2000. From 2000 to 2003, it went down to between 0 and negative 20. Between 2003 and 2008, it was above 0. Since 2008, it has been down to negative 40. As Figure 2 shows, an investment may do better or worse than its average. Thus, standard deviation can be used to define the expected range of investment returns. For the S&P 500, for example, the standard deviation from 1990 to 2008 was 19.54%. So, in any given year, the S&P 500 is expected to return 9.16%, but its return could be as high as 67.78% and or as low as 49.46% based on its performance during that specific period. What risks are there? Economic risk. So what is an economic risk? Economic risks are risks that something will upset the economy as a whole. Industry risk. Industry risks usually involve economic factors that affect an entire industry or development in technology that affects an industry's market. Company's risk. So what is a company's risk? Company risk refers to the characteristics of specific businesses or firms that affect their performance, making them more or less vulnerable to economic and industry risk. Asset class risk. What is an asset class risk? Asset class risk that an investment belongs to can also bear on its performance and risk. And last one is a market risk. Risk is classified as systematic and unsystematic risk. So what is a systematic risk? Systematic risk, also known as market risk, is the risk that is inherent to the entire market rather than a particular stock or industry. Examples are macroeconomic factors such as inflation, interest rates, and currency fluctuations. Environmental factors such as climate change, natural disasters, resource and biodiversity loss. Social factors such as wars, changing customers' perspective, population trends. Unsystematic risk. So what is an unsystematic risk? Unsystematic risk is the risk that is unique to a specific company or industry. It's also known as non-systematic risk. Specific risk, diversifiable risk or residual risk. Unsystematic risk is caused due to internal factors. It can be avoided and controlled. Examples are new competitor in the marketplace with the potential to take significant market share from company invested in, a regulatory change which could drive down company skills, a shift in management, or a product recall. What is the difference between systematic risk and unsystematic risk? Systematic risk means that the possibility of loss associated with the whole market or market segment. Unsystematic risk means risk associated with a particular industry or security. Systematic risk is uncontrollable, whereas the unsystematic risk is controllable.